When AI turns on markets, who is left standing? AI was meant to be the growth story of the decade, but it just became the trigger for a $285 billion market sell-off. A new automation tool from Anthropic set investors scrambling, punishing companies seen as potential AI victims rather than winners. As 2026 marks a defining year for artificial intelligence, is it a dangerous path to be standing in its way? Well, Russ Mould is investment director at AJ Bell. So Russ, Wall Street has been skeptical about software stocks for some time, but sentiment now looks closer to doomsday. Is this a genuine turning point?
Software stocks have been in the doghouse for a very long time. You can see that on a stock-specific basis or even an entire market like India, which has been a huge software player and has underperformed massively as a result. Intriguingly, the sell-off now seems to be on data analytics companies or companies that position themselves with that, whether they're stock exchanges, publishers, advertisers, data providers like Experian, for example, and they've really been positioning themselves as winners because look, we've got all this fantastic data that can be used, we can tailor it and use AI. So I think they've still got a chance to prove that. I think the bigger issue here is, as you said, markets don't really know what AI is going to do, and here you've had uncertainty meeting really high valuations in a lot of cases like LSEG, like Experian, like Rightmove, and I think it's as much down to valuation as it is down to narrative.
Well, let's talk about valuation now. And one big fear around AI is competition, more players and more pricing pressure. But does that mean smaller companies risk being left behind? And when a stock looks too cheap, is that actually a warning sign?
I mean, the hyperscalers are clearly hoping to use their balance sheets and their cash flow to cement the competitive positions that they already have, whether it's Meta, Amazon, Microsoft, Oracle, or whomsoever. The challenge there is their cash flow, even their cash flow now seems to be drying up a little bit. It'll be intriguing to see what Alphabet say with their quarterly results this evening, given the buyback has shrunk for the last 2 or 3 quarters. So even there are questions to be addressed. But yeah, I take your point about the smaller fry. I think what the market's looking for now increasingly is maybe not so much those who are spending most heavily, but those who can benefit from the services that are being provided in a smart way. And that's going to be a big process of sorting out winners from losers over the next 12 to 24 months.
Well, concerns about the soaring cost of AI development have been bubbling over for months. After Microsoft's worst week since March 2020, are those concerns finally boiling over?
Well, the aggregate market cap of the Magnificent Seven, all of whom are actively spending on AI, you could argue perhaps except possibly Apple, has been broadly flat since October. So there are certainly a few doubts creeping in. Equally further down the food chain, whether it's memory chip makers, foundries, NVIDIA, or semiconductor production equipment, no such doubts there yet. Their share prices are still doing really well. The Philadelphia Semiconductor Index, the SOX, is at an all-time high. But what's catching the eye here is a lot of those companies are now saying they're sold out for 2026, particularly at the kind of cutting-edge product, which is very interesting because if they're sold out for 2026, well, the news can't get any better, can it? And if the news isn't getting any better, maybe it'll start getting worse, and the markets definitely won't want to see that.
In an industry used to eye-watering AI bets, NVIDIA appearing to blink on a major OpenAI commitment has caught investors' attention. So what does that tension tell us about the next phase of the AI boom?
Yeah, I mean, there's an awful lot of dependency, it feels, at the moment upon OpenAI, ChatGPT's founder and developer. And if the company is struggling with its latest funding round, because NVIDIA is now talking about that being a loose commitment, not a firm contract, that could have ramifications. It's one of the reasons why Microsoft stock wobbled last week, because they acknowledged that a huge part of their backlog came from OpenAI. So it is a genuine issue. And if one of the sort of biggest spenders of all has to slow down spending voluntarily or involuntarily, you could get a ripple effect through the food chain. And then those massive backlogs we've just talked about at, whether it's ASML or TSMC or NVIDIA or whomsoever, maybe they're not quite so sound. It's a bit of an echo of 2000, the top of the tech bubble, when companies had massive backlogs, but then they couldn't deliver. So that meant there was a slowdown in end markets. And then in the end, the backlogs weren't as big as they thought because people had double ordered. And if we get any evidence of that, and there's no evidence of it now, I must stress, but if there's any evidence of that, that was what caused a lot of the trouble back in 2000. So we have to be on alert, not just looking at profit and loss accounts, but book-to-bill ratios, backlogs, and even inventory and trade receivables, because any stress may show up in the balance sheet first.
Let's talk Amazon now, and bulls believe that the stock is primed to reclaim market leadership, with optimism hinging on renewed momentum at AWS. So has the bar been set too high for its earnings later this week?
And US companies, let's face it, are pretty good at managing expectations. I think the average beat for a quarter across the S&P 500 is 75%, 77% according to Standard & Poor's. So they're pretty good at this. But yes, again, all attention will be on AWS, the retail margins, and what that CapEx number is going to be. And that'll be a big issue at Alphabet as well when it reports the CapEx figure.
Well, Sam Altman may be backing AI-driven drug discovery, but over at Novo Nordisk this morning, shares plunged after it warned of a sharp drop in sales. Is this short-term turbulence or a sign of something more concerning?
Well, I mean, Novo's share price is now a long way below its high. It's actually back to where it was in summer 2021. There's been a considerable weight loss there, if you'll pardon the expression. The market cap's come down a long way. It's wiped out the rally that we saw since November. It is, I think, capitalism working as you would hope it would. Really high returns on capital, attracting competition and more capital, and therefore returns are diminishing. And Novo hasn't yet been good enough to stay ahead of the game. Eli Lilly's certainly caught up, and there are other competitors waiting in the wings. And Novo's now admitting that there is price competition out there. Surprise, surprise.
That was Russ Mould from AJ Bell. Don't forget, you can watch more videos on Reuters.com.